Hi there and welcome. Patrick Prunty here with Marshall Reddick coming to you from beautiful Newport Beach, California. As always, I'm excited to be with you and for the next hour as we discuss our newest investment, Marshall Reddick Mortgage Fund. Boy, certainly been an interesting last few months due to COVID-19. I hope all have been staying healthy, sheltering in, and spending a lot of extra time with family. As for real estate and Marshall Reddick, well, real estate's an essential business, and that's a super good thing, as we here at Marshall Reddick have never been busier. All lines of our business continue strong, but our private loan business continues with investors just like myself out on the prowl looking to scoop up deals. I believe our private lending business is in for a boom as well over the next 6 to 12 months as conventional lenders sort of tighten up as we've started to see, and also as we start to see the effects of the virus on the real estate market. On the property side, no doubt about it, due to loss of incomes for a lot of folks, short sales, foreclosures, and the like will be returning. With this in mind, I'm sure you'd agree, as long as you're well capitalized, prepared, of course, and have the access to real estate investments like we do here at Marshall Reddick, this is a great time to be an investor. So let's dive in and learn how you can get involved with big gains post-pandemic with Marshall Reddick. Before we go any further, I'd like to discuss briefly my role as the Director of Private Lending so you can get an insight into how I do things and how we look at things from our loan perspective here. So my role revolves around a lot of different things, but certainly the development of our mortgage marketplace, our loan program implementation, how those loan programs change accordingly, certainly the hiring and firing of loan staff, and one of the most important things is the management of that pipeline, dealing with the borrowers and the lenders, the capital partners, and also new growth, new business relationships with borrowers and with lenders. We strive to work with borrowers on an ongoing basis to help support their businesses, not necessarily working with one-off borrowers on one deal and then never talking to them again. For us, it's all relationship based, and again, that's on the borrower side as well as the lender capital partner side. I'm also proud to say that I'm the senior Marshall Reddick staff member. So I started my career back in 2003, and it's certainly been a wild ride, and I can't believe that in a couple of weeks here, come June, I'm going to be celebrating a 17-year anniversary. So really enjoyed my time here, and I'm looking forward to what the future holds for you, for me, and for Marshall Reddick. So diving in a little bit to the mortgage fund, certainly our topic for the next hour. This is a Regulation D 506C general solicitation private placement memorandum. Now, I know those are fancy words, so we'll break it down a little bit because it's actually very easy to understand. But this vehicle is organized as a California limited liability company. It's a partnership. So in other words, not those fancy words, we're talking about this being an investment fund, and it's an investment fund managed by Marshall Reddick. It's currently raising capital by issuing restricted securities, and in return, it will pay a solid, consistent, and safe return on investment. And I'm sure we'd all agree we want to earn a good return, a nice return, but it needs to be a solid and a safe return. The capital needs to be patient and it needs to be protected. We certainly take that approach to all investing here at Marshall Reddick, and especially into this newest vehicle, our mortgage fund. Important to note that this vehicle is only open to accredited investors. And not everyone's clear on what an accredited investor is. So specifically, there's two ways individually that you can qualify. First, from an income perspective, and the second from a net worth perspective. So on the income side, we're talking about high incomes, right? So $200,000 in each of the past 2 years with the same outlook for the current year, or $300,000 if you include your spouse. Moving in onto the alternative to that, which would be the net worth qualification, we need to add up bank statements and brokerage statements and retirement accounts and equity in rental properties, and so on and so forth. And we need to deduct from those amounts liabilities such as credit card debts or student loan debts. And then we need to shake out at the bottom there of your balance sheet, if you want to call it, that you've got a net worth greater than $1 million, inclusive of one spouse. So if we can get you in on one of those two, great, we'd love to have you. And note that we have to qualify that. We can't just take your word for it. And so one of the easiest ways to do that is going to be obtaining an accreditation letter from one of the professionals that you work with. So that could be a CPA, that could be a registered advisor or a licensed attorney, someone who's got intimate knowledge about your financial situation and who can qualify you. We can certainly take that letter signed by that licensed professional. Alternatively, we will be needing to see W-2s or 1099s, K-1s, 1040s, all of those different types of documents that will help us verify either income or net worth to get you qualified. As we move into the mortgage fund details, it's important for one to understand the private lending division with Marshall Reddick and where it's come from. This division launched back in 2009 and funded its very first few loans in 2010. And we took a very slow, organic, and conservative growth, brick by brick, really building this program from the ground up. Now, 2009 and 10 were very interesting times for the real estate market. Things were really in chaos at the time, coming off of the 2008 recession. And we were just hitting the bottom there, and there was so much opportunity to invest, right? But what's important to take away here is that that slow, organic, and conservative growth really laid the groundwork for the pure success that our private lending division has become today. And we're taking that same approach to the Marshall Reddick Mortgage Fund with a very slow capital raise, starting out with friends, family, and some close VIPs. And again, we're just replicating the private lending division that was started over a decade ago. So back when we launched this, it really started with just a few trusted regional representatives. And those unfamiliar with Marshall Reddick might not quite understand what a regional rep is. But for an example, if you were to visit our website, you can see here I've got a screen clip from our properties section. Here we've got the markets geographically in which we operate today. So in the old Marshall Reddick, we would have an affiliate, a non-Marshall Reddick employee or real estate agent or property manager located in these markets that would kind of service our clients that we referred over. And so at the time, again, 2009 and 10, we had some great relationships with regional reps around the country, and a few of them approached me and the team at Marshall Reddick at the time and said, guys, there's so much opportunity, distressed sales, short sales, foreclosures, all of those different types of things. And they were really all invested, all of their personal capital, buying up these properties, fixing them and reselling them and making some really, really good returns. And so they approached us at the time and said, geez, you guys have this massive database of investors. Would you or they be interested in lending us money to help us continue to buy some of these assets that are out there, because there's just so much more opportunity? And wow, that concept really hit me like a ton of bricks. And so I said, sure, yeah. I mean, we had some really solid trust in some of these folks. And by this time, I had worked for Marshall Reddick for about 5 or 6 years full time. And these reps used to come out to California all the time. And so I really got to know them on a personal level. And so I was comfortable with the idea of lending them money, even though lending was very new to me and to Marshall Reddick in terms of lien positions and security instruments and loan to values and title insurance and all these different things that you need to understand to become a lender, a private lender, and to do it safely. So again, started with those reps, and it also started with our own kind of business, personal, and family capital. So I didn't have a ton of money at the time, but I got my father involved, and certainly Marshall Reddick got involved, and a couple of my coworkers, and we just started making some loans to these regional reps. We're talking very small, $25,000 or $50,000. But we started earning a great return, right? 10% on our money, and we really thought that this was the greatest thing, and we're very excited about the opportunities to unfold. So again, very small, 2010 through 2013, in those first handful of years that we were doing this private lending. And then it kind of really started to pick up some steam. 2014 and 2015, it was outgrowing what we could do from our personal or family perspective in terms of that capital to fund these loans. And so we knew that we had to open it up to some more of our VIP Marshall Reddick clients. And so 2014 and 2015, we did so. Again, further started to gain some momentum, and so we took it more of like on a public view in 2016, and that's when we launched our mortgage marketplace that you would see today. It's certainly changed and it's grown and it's improved substantially, but our slow organic growth continued then into 2017, 2018, and 2019 when we had our best year, originating 372 loans for $42 million. So very proud of where this has come, but again, we're taking that same kind of slow organic growth with the Marshall Reddick Mortgage Fund. Now, direct lending is what the program has been doing over the past decade. And what I mean by that is we're talking one lender on one loan. So as any loan officer, loan broker, we do all of those things, taking the loan application from the borrower, gathering all of their information, doing the underwriting on the loan, right? Evaluating values to understand if this is a good loan to make or not. Do the appraisal through an appraisal management company when applicable. But what we didn't have is we don't have the capital, right? So we have to source that on every single loan. And that's what I mean by the direct lending and the one lender on one loan. But it doesn't stop there. Certainly after we then take that commitment to fund each loan, we're handling all the third-party communication and we're preparing those loan documents, and we're actually getting to the funding table when it is the direct lender would wire the money into escrow, and then the deal closes, and then we get you boarded with loan servicing and so on and so forth. And it continues, then we don't just forget about you as the capital partner as you funded this loan. We handle and are involved all the way up until payoff on the loan. You'll sign a release of lien. And then, of course, we're solicitating reinvestment, because the idea of keeping your funds invested at all times is what real estate investors want. Now, this is kind of the look, right? That's how it has been happening as we back up and take a quick peek at the growth that we've had in each one of these. So we're talking in 2019, 372 different capital partners invested for a total of that 42 million. It can sort of be a hectic business until now. And the reason for that is the Marshall Reddick Mortgage Fund. So instead of all this direct lending, now you can invest in the vehicle, in the pool, and it is Marshall Reddick who will be able to guarantee the capital and will not have to source it on each loan. It'll allow us some scalability to take this business to the next level. So you have some handouts that you can download as a part of this presentation. And so one of those is the flyer that you've got on the screen that kind of gives some logistics and some mechanics about this. We'll be talking a little bit more, but know that you've got some other handouts too, including the full private placement memorandum. But on the screen here, you can see that we've got an example of the investor return and how that would look to you. And I want to break that down a little bit. It's actually very easy to understand as long as you go ahead and break it down. So for this hypothetical situation, we're going to use round easy number of $1 million investor capital on hand. Again, we're going to be going to 100 million with this fund, but I want to keep it in a very simple example so everyone can understand how the returns will work. So but in this, again, hypothetical, we're going to be earning an 11% return, or 110,000, as that 11% is based on the investor capital on hand. Now, this is going to be after expenses, including the management fee. But if you think about it, the fund will have very few expenses. It doesn't have employees, right? It doesn't rent office space. Marshall Reddick does all of that. And that's really what the management fee covers. It's not a profit center, but it kind of offsets the costs to manage this fund. And again, very standard from a PPM standpoint. But again, 11% return. And so if we look at the investors getting paid first, that's the preferred return. And that's an annualized 6%. So 6% of 1 million, that's going to be 60,000. right? And after the 6%, we'll be looking to the net profit. So what's left over, again, after expenses, including the management fee, and after the payment of the preferred return, which is 6%, broken down quarterly. The distributions are quarterly. And so that would be 1.5% quarterly times 4 quarters gets you to the 6% annualized. So 11 minus 6%, we're talking 5% in this hypothetical scenario that would be left over. That would be an annual net profit, or 50,000 based on that 1 million on hand. So this is the profit sharing element of the fund. So half of that profit goes to the investors on top of their preferred return, and Marshall Reddick earns its money as the other hand of the profit share. So again, after the investors get paid. But now breaking that down and coming to a conclusion here for the annual investor return, we're talking 60,000 preferred return and 25,000 profit when the fund earns an 11% return after expenses based on $1 million. So and that's at 6% plus 2.5% profit for a very attainable 8.5% annualized return. And, you know, I like to think that we're going to be able to earn substantially more than that, but we want to be very conservative on this. Let's have a quick comparison here between the direct lending and the mortgage fund. In the direct lending, the capital partner earns the interest. We don't arbitrage that at Marshall Reddick, but Marshall Reddick earns money by earning the loan fee to put the deal together that's paid by the borrower. It's a battle to stay invested, right? And what I mean by that, it's like you fund the loan directly, and then you're subject to when the borrower pays you off. So when they pay you off, you get your money back. And on the short-term side of our loan programs, you could be getting that money back in 5 to 6 months. So it's great to earn 9 or 10% interest, but when you get your money back, you're now earning 0 as your cash sits in that money market account. You got to battle to get invested again and again and again, and sometimes it becomes not as passive as one might like. You're also, your other option in terms of waiting for the borrower to pay you off would be a secondary market sale. And that's certainly something that we help with right on our marketplace today. We don't have a lot of that activity. Most folks are very happy with earning the interest, but if the time comes, we could certainly sell that loan in the secondary market to another investor. Kind of some pros and cons here. When doing the direct lending, you got to look at it more of like the all eggs in one basket. I mean, it is your decision to fund that loan. Your capital is all into that loan. You are on the documentation, and certainly Marshall Reddick's here to help you if there was a default, but you are taking the risk financially in that situation as the direct lender. And of course, then you get the choice of the loans, right? We'll give you great visibility on the marketplace, but it ultimately is your choice on the direct lending side to invest in that loan or not. Whereas you kind of take that and compare it to the mortgage fund, separately here, the fund will earn the interest paid on all the loans, but it will also earn the loan fees paid on the loans. And then the capital partner in this situation earns that preferred return and that profit share. A little bit different model there. You're always invested and you're always earning every day that you are a member of the fund. You get out when you desire. Now, there is a 12-month minimum lockout, but it's a very short period of time. And then after that initial 12-month period of investment, you can get your cash out in a very liquid capacity. It's a 90-day call thereafter. So again, you're not subject, like on the direct lending side, to the borrower paying you off or having to sell in the secondary market if you don't want to. You can just get out of your investment by asking for the capital back. It's going to operate very much like a hedge fund or a mutual fund. As far as the risk goes, there's people on both ends of the spectrum here. So from my perspective, you're kind of spreading that risk across the pool. Certainly the fund is going to have defaults. That's part of lending money, but we at the management team will just deal with those defaults. The individual investors, the capital partners in the fund, they won't even know necessarily about the defaults. We just deal with them. We get the property sold or whatever may be necessary in order to get the capital back into the fund and then lend it again and again and again. Kind of the con here, if you want to look at it that way, some people look at it as a pro. You will have great visibility on what the Marshall Reddick Mortgage Fund is investing in, and I'm going to show you that here shortly, but you're not going to have any choices in that. Your choice is that I know that management knows what they're doing and that they're going to put us into safe, secure investments that earn a nice yield, but you're relinquishing the choice. Now, the marketplace, again, it's launched in the summer of 2016. This is like a multiple listing service for loans, and I'm going to show you what I mean by that when I bring that on the screen. But each loan has a detailed listing page that shows many of the details, if not all of the details, that one would need to make a decision on whether that funding of that loan is a good investment decision for them. And so this is a very cool part of the Marshall Reddick website, and I encourage you to check it out if you haven't. What it also does is it provides some serious transparency on what our portfolio looks like as a whole. And again, you're going to be able to kind of segregate that to just hone in and focus in on what it is the mortgage fund is investing in at all times. Funded loans never leave the marketplace. Okay, once they're funded, they just change loan status, and this is happening in very real time. And those who are familiar with, you might go to the marketplace today and see that there's only 7 or 8 loans available for investment, and tomorrow those 7 or 8 loans are gone, but there's a new 7 or 8 or 10 loans available. And then as they become funded, they kind of just change loan status over time. So, thinking long term here, 15, 20, 25 years down the line, you're going to be able to see what Marshall Reddick's pipeline looked like and calculate things like the default rate. And it's going to all be shown publicly for everyone to see. Now, here's a screen clip that's going to show you the definitions of all of our loan statuses. I'm not going to go through these individually, but a lot of folks are going to want to look at this presentation and utilize the definitions as they kind of do their due diligence on the marketplace to understand what each of these loan statuses means. So the transparency and how to use, so I'm going to bring the website up so that we can go through a few examples, and those examples are going to be what does the current pipeline, Marshall Reddick's loan pipeline, look like right now or at any point in time, because again, we're giving you a real-time public view on our portfolio. Or another example I'm going to give you is the default rate and how to go ahead and calculate that at any time. I'm also going to show you how you can get some visibility on exactly what the mortgage fund is doing separately from Marshall Reddick's overall portfolio. Let's now bring down the presentation, and I'm going to put on the screen for you our homepage, right? And so to find this marketplace, you simply are going to hover over Invest, and you're going to click on Mortgages. And when you do that, you're going to get to what I call the list view. Right, so you can see listings here of all these different loans and all of their different loan statuses. So when I come to the website or the mortgage marketplace first, I like to come up here and hit this clear button in the top right. When I do that, that kind of selects everything and then will allow you to further refine the criteria that you want to look at. So I use this More Filters button here, and in the center of the screen is what I'm going to focus on, which is the loan status. I just gave you all those definitions. Now notice you've got a couple here, draft and underwriting. The public doesn't have access to those. These are loans that are working their way through the underwriting after loan application from the borrower to get to available. You will see available on forward. And so again, I want to give some of those examples, right? We talked about is what does Marshall Reddick's pipeline look like today? So I'm going to deselect all loan statuses. And when I do that, there we go. Now you will be able to reselect approved for funding, funded, extension, forbearance, and payoff requested. These would then represent those loans in the pipeline right now. So you can see up here in the top right about 446 mortgages. Again, that would represent someplace in the neighborhood of $45 million total across those. And if I wanted to go dive into some of those, I can click done here. Again, I've got the listings and the various different types of loan statuses. And let's say, for example, I wanted to dive into the details, right? I can use this full details button and open this up in another browser. And this is what I was talking about, that detailed listing page, where you'll be able to identify all the different specifics about this loan, all the different metrics over here, monthly payments and interest guarantees, loan details, timelines, loan to values, third parties, the photos of the subject property, valuations, comps, I mean, you name it, it's all here. Now, coming back in, so that was the pipeline we just talked about, and you'll be able to, again, to see that in kind of real time. Now, what about the default rate, right? Which we're just going to be showing that. And again, defaults are certainly not something that's ideal, but it's a part of the business, and so we just need to publicly show that. So I'm going to go ahead and deselect all loan statuses, and I'm going to select those events of default, which are going to be settlement with loss, deed in lieu, foreclosure sale, and REO. Okay, and so when I do that, I can see that I've got 12 mortgages, 16, when in the last slide there I showed you was 16 total defaults since the marketplace went live in 2016, and then that 16 over our other end, to calculate that default rate, we're going to be looking at those loans that were paid in full or settlement with profit. Okay, so we're at 752. So 16 over 752 is going to be that 2% default rate that I just showed on the prior slide. Now, one last example and where we get back onto our presentation is going to be separating out the Marshall Reddick Mortgage Fund. So you got to scroll down a little bit more here in our more filters into the investment fund section, and this is where you can go ahead and click on Marshall Reddick Mortgage Fund. Now this would be only loans that Marshall Reddick Mortgage Fund is the lender, to kind of give some public visibility on what that fund is doing at any point in time. Again, the fund's been operational for about 45 days. It's currently in a slow capital raise, and so you can see here the corresponding numbers. So there's a couple in underwriting that are working their way through the channels that the fund will be taking. We've got one in funding in process, one in approved for funded, 11 that have already been funded and already have 2 payoff requested. So if I sum those all up, I'm going to see that I've got, let's see, 18. It looks like mortgages in the Marshall Reddick Mortgage Fund at this time. So that number is going to only grow over time. There'll be less direct lenders funding loans on the marketplace and more fund capital being invested into these loans. So if I click off done again, now that I've got all the Marshall Reddick Mortgage Fund loans selected, you can see that they're all tagged, right? And this is just indicating that this loan is funded by the Marshall Reddick Mortgage Fund. And again, you could dive into the individual details of each one of these whenever you'd like. So again, just kind of a little bit on how to use the marketplace as well as the visibility. Now, we're going to have a forthcoming reporting module as a part of this marketplace, as a lot of people don't want to have to go through and calculate those own things and kind of deduce what the default rate and all those things are. So we're going to be showing those. And on this forthcoming reporting module, we're going to be showing things like total capital, right? Like I said, my pipeline currently, which is about 450 loans, represents about 45 million total capital. We're going to be able to see that. You're also going to be able to see what the average and median loan sizes are, loan to values, and is that loan to appraised value, loan to current market value, loan to after renovation value, some metrics to kind of get an idea about the overall risk of the portfolio, as well as separating that out again by those loans that the fund is in. And we're also going to be talking about the allocation of short versus long-term loans. And I'm going to break that down on further as we move through this. We're going to be seeing historical averages, median loan terms, and one of the coolest parts, I think, is you're going to be able to see a map view, kind of a geographic concentration about where our portfolio lies across the United States, and then again, separating out the fund to kind of understand where it's invested. And you'll start to see that we've got some strongholds in certain markets. A lot of those are markets where we at Marshall Reddick have our own office. and certainly in areas where we have a footprint, right, where we know brokers and property managers and attorneys and contractors and all of those people to help us in the event that we need help. We'll also be showing kind of the distributions and the returns publicly. So again, this is going to be a very cool part of our marketplace as Marshall Reddick moves forward at this time. Okay, so the fund and kind of some house cleaning items here. We're going to be talking about the current status of what it's doing right now, the logistics and the steps to invest, the safety precautions, and of course the investment strategy. As far as the current status, we're open and accepting subscriptions at this time. Again, it's been on a soft launch with friends, family, and close VIPs, very similar to how I described that slow growth with our direct lending program. In addition, we're not only funding loans, but we've acquired our first property. Right, and that's very exciting as we're going to be, again, taking some bigger rips and looking at some bigger gains post-pandemic on the property side of things, because there's going to be some opportunities, again, when those foreclosures and short sales show themselves again, which is coming. We're also in the process of implementing some capital partner software, some investment software. And this is very cool because it's going to give you some access into specifically your portion of the mortgage fund. Now we're going to be using Appfolio, and that's also cool because I'm sure a lot of folks listening in are rental property owners and very familiar with Appfolio. Their property manager uses it, and so they know that they've got a portal in, and they can look at statements and contribute money and things of that nature. So same kind of concept for the investment management software. You're going to be able to log into your portal, and you're going to be able to see the date you invested and how much you invested in the fund. And you're going to be able to contribute more capital right there with the click of a button if you'd like. You're going to be able to request the withdrawal of your capital if you'd like. You're going to get to be able to download all of your quarterly statements. You're going to be able to change with your distribution preference. So the fund has a cool option to be able to reinvest your distributions as opposed to taking them in cash. Right, so you're going to be able to toggle that and say, well, now I'd like to reinvest, or now I'd like to take them in cash, and it'll all be done inside your portfolio with Appfolio. So moving on to the mechanics and the logistics, right? So you must be accredited. We kind of talked through that already. There's a $25,000 minimum investment, so a very low threshold, and there's going to be, of course, that 12-month minimum hold. Now, we talked about the 2% asset management fee, and that's not a profit center, and it really just offset the costs of Marshall Reddick to run this fund and to be able to generate these returns and pay a nice return to the capital partners. Those returns, again, break down with a 6% preferred return and a 50% profit share. And again, the distributions will be paid quarterly. And don't forget about that reinvestment option. That's very cool. Think about it from a self-directed IRA perspective or self-directed retirement perspective, whereas before with the direct lending, right, you have no choice but to accept those mortgage payments. Right? But if you invest in the fund as opposed to doing the direct lending, you have the option to reinvest those. Otherwise, if you take them into your custodial account, they're going to be sitting in the money market account earning very little. That's going to overall hurt that annualized return. So know that that reinvestment option is very cool, and again, akin to a mutual fund or a stock. So what are the actual steps to invest? Right, so number one, consult with Marshall Reddick. And I'm always available. I give my cell phone to everybody, so give me a call. I'd love to have a conversation with you. But you can also touch base with other folks that you're familiar with at Marshall Reddick. So your real estate advisor, for example, right? They're all on the up and up on how this fund works, and you can start with them and then move to a conversation with me or another member of the lending team at Marshall Reddick. We're going to determine accreditation. And again, we can't just take your word for it. We'll actually have to look at and review documentation and hold that documentation on file. And so the easiest way to do that is, again, get one of your folks that you work with, CPA, attorney, so on and so forth, to be able to write a letter and to sign off and show that you are accredited. You're going to be doing some due diligence and reviewing the private placement. Again, you have the private placement as a handout that you can download. And although it's a large document, 60 pages or so, and it's filled with legalese as required, it really breaks down how the fund will operate, and it's written in a fairly easy to understand manner. So spend some time there, but write your questions down. If you have questions and so on and so forth, feel free to send them my way or to discuss them with another member of the team here at Marshall Reddick. After we get through and decide that yes, you're accredited and yes, you want to move forward with an investment, right? We're going to have an investor questionnaire that needs to be completed, followed by a subscription agreement. So those will be 2 pieces of documentation that will need to be filled out. I'm happy to do this with you over the telephone and send it to you for e-signature. And then lastly, you will go ahead and deposit funds. It doesn't have to be wire transfer. That seems to be the easiest, and you'd be doing so into our subscription account, the Marshall Reddick Mortgage Fund subscription account. So here is that private placement that I mentioned. So make sure to download this and get reading. Here are just a quick glance at what the questionnaire and the subscription agreement looks like. Again, you should have those as handouts that you can download directly from this presentation. Moving on to the safety precautions, we're going to only be doing secured residential real estate investments with this capital. And I emphasize secured and residential because that's what we know best. And we're going to be staying away from equity investments. And I'm going to give you an example here as what a lot of funds out there will be doing, which would be putting the capital into equity investments. So here's an example, large opulent apartment building, waterfront. And don't hold me to these numbers. I'm not a commercial real estate guy. I put this together quickly, but you will get the gist of what I'm talking about. So again, a lot of funds that are out there are going to be raising capital, and they're going to be using that capital that they raise in an equity capacity. So in a deal like this, much larger deal than what we'll be doing, you might need 35 or 40 million in equity to do this deal, right? And again, we're going to stay away from that. We're going to be on the opposite end of that spectrum because this equity is behind or unsecured, whereas that purchase money debt here at 45 million is what is secured. So if this deal goes sideways, it will be those equity investors who lose, right? It would be that first lien position, purchase money debt, that 45 million here that would end up foreclosing in the event this went sideways. So that's what we're going to focus on. We're not going to be doing any large buildings like this. Again, we're going to be originating mostly loans secured against single family homes, small multifamilies, right on the Marshall Reddick mortgage marketplace, but we're going to be doing in that first lien, very safe position to be in where we can't lose. We might take some property back, but we can't lose our entire investment. Further on the safety precautions, it's going to boil down to the capital allocation and the asset allocation. So 80% of the capital from a management perspective is going to be invested in first lien debt originated by Marshall Reddick. So everything that we know that we're comfortable with, that we've been doing for a very, very long time, working with borrowers that we have previously, that we've got a long track record with based on trust. We will, however, be doing about 15% or so of the capital in property acquisition. And you can call this flipping, but a lot of times it's going to be non-retail flips, meaning not sold to end users. It will most likely be sold to investors. And so the property acquisition that we will do will be in the markets where we have our own office, our own W-2 property managers and real estate agents and all of those parties that we control. And so we'll be stabilizing these properties, fixing them up, renting them out, and then most likely selling them to investors who prefer to be rental property owners right on the Marshall Reddick website. Kind of gives us a unique economy, a scale there, and we'll have a lot of good success on that property side. We're also going to be, allocating 5% or so to secondary market debt purchases and non-performing debt. Now, I'm not necessarily the hugest fan of non-performing debt, but there will be some big opportunities to take some rips and to increase our fund return and take advantage of some of those post-pandemic fallout. But we will do more than the non-performing side. We will do more of the secondary market purchase where folks just choose to exit and are willing to sell at a discount. That will increase the yield to the fund. Now, inside and breaking down the asset allocation inside that 80% first lien debt, we're going to be doing about 50% of that 80%, which is about 50% of the overall capital in the fund, in extremely safe long-term loans. And we're talking 50 to 65% loan to value with a third-party appraisal to back it on nicely fixed up rental property, right? And these are 5 to 30-year terms, and we'll be collecting 6 to 8% interest. Now, these programs are really geared towards the self-directed retirement borrower, regardless of how good a credit they have or how much cash they have in the bank. If someone wants to buy rental property using their self-directed retirement account, they can't get a bank loan, so they must go private. And there's an absolutely massive market in this country for non-recourse debt, specifically for self-directed retirement accounts. And so a big part of this fund, again, 50%, as you can see, is going to be allocated to supporting that massive market. The other portion of this 80% first lien debt is going to be in our short-term program, right, with still a pretty favorable LTV at 70% maximum. But do note that in our renovation loan programs that we base that loan to value on the after renovation value. But these are very short-term loans, 12 months, higher interest rates because they're at higher LTVs. So we're talking 8 to 12%. And I encourage anyone who's interested to go check out our loan programs, right? We publish those publicly, and you can see them right here using this URL and webpage. On the property acquisition, stabilization, and disposition side, again, those flips I was talking about, again, we're going to be focusing mostly single-family homes in geographic locations where we have an office. Those offices today, we're talking California, Texas, Tennessee, and Florida, some really fantastic markets, and we're all over those in terms of scouring the market for deals. That means showing up to the trustee or sheriff sale, those foreclosure sales. That means constantly watching a drip campaign and looking for those short sales and those distressed properties that can be scooped up for a deal and then fixed and then resold for a handsome profit to help us increase that yield. Again, we're going to have a good amount of activity, but we're only allocating about 15% of the capital on this side, but it's going to really help us increase to mid-double digit 15, 16, 17% returns in the fund, which again, you're going to benefit from that due to that profit share. Note that, again, from a safety precaution perspective, Marshall Reddick Investments always include expert analysis. Everybody on my team is a professional, and that's very important for an investor looking at a group, at a company such as Marshall Reddick's. Everyone needs to be an expert and really understand the ins and outs of what they do. As far as the underwriting goes, I mean, that's what our private lending department does, right? It underwrites each loan. We do that in-house. I've got a small team of underwriters here out of Newport Beach with me, and we spend a lot of time and effort making sure we get the underwriting correctly, and that keeps us out of trouble, right? And that's why our default rate historically is so low. That default rate historically over the past decade is at 2%, just as you saw a few slides previously. We're always, of course, going to be utilizing third-party escrow. Title insurance is absolutely mandatory. And of course, insurance, right? If we're the property owners, we're going to insure the property. And if we're the lender, we're going to be forcing the borrower, of course, to carry insurance in case there's something problem with the property like a fire or so. Again, everything that we do at Marshall Reddick, and this again goes to the fund as well, is going to be residential, and it's going to have real estate security. Again, no equity investments. Talking about the investment strategies here. So management team, very important. And I talked about the PPM earlier. Again, that stands for Private Placement Memorandum, but you can skip right to page 34 to see the bios of that management team, which I'm a part of and I'm very proud to be a part of. But I've got here Ross Nelson and Scott Pastel, two colleagues of mine that make up the remainder of this management team. And these guys are very, very well qualified. I've worked side by side with them for more than a decade as we've been building Marshall Reddick from the ground up. And we all invest directly on our mortgage marketplace. We're all rental property owners and have been for many years. We've all invested heavily into the Marshall Reddick Mortgage Fund as we believe in it, right? And understanding what the team does and the experience and where they came from is really important to knowing and trusting that we absolutely understand what we're doing and that we're going to be good stewards of investing this capital and returning an amazing return on an ongoing basis. So again, you can see our bios on page 34 of that private placement. Now, in regard to the strategies, we're going to talk short-term virus-related, but also go over our long-term recession-proof plan. Very important, right? Because we certainly want to take advantage of some of those opportunities coming here post-pandemic, but we also want to, regardless of this recession or regardless of the one in 10 years from now or the one 10 years after that, we have a plan that's going to keep this fund very stable. Consider it an income and dividend fund. So the virus-related opportunities are really going to come, again, focusing on our capital allocation from the latter 20%, where we're going to be taking some big rips on properties and flipping those for big gains. But also we're going to be taking some opportunities in the secondary market or on some non-performing debt. Again, this is going to represent about 20% of our capital allocation. As far as those properties, again, I want to just mention we'll be doing those in our markets that we have a footprint. And Marshall Reddick has some really unique economies of scales and some opportunities, and those come from a couple of different things. Number one, we have this very large database of customers, very loyal customers that have been with us for a long time. And we owe a lot of that to Marshall Reddick, the individual. He started this business in the late 70s, and he's touched so many people from an educational perspective, and we still do that, but it's this large database of folks who direct lend, who are rental property owners, who are now going to be investing in the fund. And then you couple that up with our national footprint, right? And now that instead of working through affiliates around the country, we're now implementing our own offices around the country where we have our own folks and we have some more quality control. I mean, it really gives us these unique opportunities to be purely successful, just like we have been with our direct lending program over the past decade. Now, I'm talking specifically about the recession-proof plan that I mentioned. Again, visiting back the capital allocation, this is going to be on the opposite end of the opportunities that we take some big risks. This is going to be in that very safe first lien debt position, which again represent about 80% of the capital. And in this case, focusing even further inside that asset allocation and honing in on the 50% long-term loans. Discussed these earlier on, but I wanted to show and bring up the rate card that my borrowers see. So this is public as well in the borrow section of our website. And again, these are geared towards the non-recourse self-directed retirement borrower. Certainly other folks are welcome to utilize these for special niche situations, such as having more than 10 financed properties. So you know that you can't get an 11th or a 12th from a conventional lender, and that Fannie Mae guidelines prohibit that. So those folks have to come to us and borrow privately, right? Again, there's a massive market for this type of debt against residential, single family and small multifamily properties. And we are going to be investing heavily into that market, again, at 50 to 65% loan to values. So this is going to really stabilize that fund, very low leverage and consistent monthly payments at a 6 to 8% range. Now, don't forget that the fund's going to be earning that origination fee, that borrower paid origination fee, which is going to help us increase that yield very reasonably into the double digits. Now, I'm going to wrap it up here with a little Q&A, and I'm going to do that with 4 questions that I get constantly. First, starting with, I've been a direct lender for some time with Marshall Reddick Mortgage Fund, I've been a direct lender for some time. And with Marshall Reddick Mortgage Fund now operational, will I still have an opportunity to invest in loans directly on the marketplace? And yes, you will. But if you think about it over time, there's going to be less direct lending opportunities. As the mortgage fund continues to raise capital, it will take precedence on the marketplace and it will get the nod every time. Now, one thing that we will be doing in an effort to churn the capital in the fund is going to be selling on an assignment, performing first position loans, both short and long term, to folks who do not want to get into the mortgage fund. And there's, just face it, there's some people that just love the direct lending and want their name to be on those and loan documents, and they want to own that mortgage and they want to make the choice on it. And there's some people that absolutely won't do that, that only want to be in the fund, right? And so we now have the fund specifically after 10 years of it being called for. People love the direct lending, but again, it gets sometimes not as passive as one would like, and therefore you want to be able to put it in that pooled situation where you're earning daily. But know that there will be some continued opportunity. A lot of those will come in the secondary market, where loans originated by the fund are sold to direct lenders right on our marketplace. As far as a capital investor, the Marshall Reddick Mortgage Fund, what kind of income documentation will I receive? Now, again, it's a partnership and it will be done with a K1. So at the end of every year, you as an investor will get that K1 to support the distributions that you receive. Now, I get this one as an interesting question. 50% of the capital allocated to your long-term program at interest rates of 6 to 8%, how will the fund be able to earn a mid-double-digit return? Again, that 15 or 16 or 17%, or even higher than that. Again, it's about churning that capital. And think about this from a conventional lender standpoint. Conventional lenders are not in the market to collect interest over time. They're in the market to originate, collect that loan fee, and then they sell their loan off to Fannie Mae for the purposes of getting their capital back and lending it again and then earning another loan fee. So the fund will do a lot of that as well. We're going to portfolio a lot more of our loans than a conventional lender would, but we're also going to be churning that capital in order to earn more origination fees in order to increase that yield. And so I don't think we're going to have any problem earning that mid-double-digit return year over year. Hey, I'm interested. What are the next steps to invest? So I kind of talked about that a little bit earlier, but I'm going to show those one more time for those folks who are ready to go. I look forward to working with you. But the steps to invest are simply consult with Marshall Reddick. That's me, a member of the lending team, or any other Marshall Reddick staff to kind of get some preliminary information or get some questions answered. We're going to determine accreditation, verify by looking at all of your documents, unless you have a CPA, attorney, or such that can write you that letter and give us the accreditation that we need. You're doing some due diligence, reviewing the private placement. You're also going to then have to fill out the investor questionnaire or the subscription agreement. Again, I'm happy to do those with you, send you those for DocuSign, make it very simple. They're very easy documents to understand, and it's not a long process to invest. Lastly, we're going to be wiring your funds into the subscription account. That can also be done via check or ACH, any way that's convenient for you to get the funds to the subscription account. Again, my name is Patrick Prunty. It was my pleasure being with you as always. I really love what I do, and I am very excited about the opportunities that lie ahead for you, for me, for my team, for Marshall Reddick, and for the Marshall Reddick Mortgage Fund. So I look forward to working with you, and please do not hesitate to call or email questions or concerns. So everybody take care, stay healthy, and have a great day.